Hey there, it's John here again, and welcome back to the channel. It's May 7th, and this is your real estate and market update, specifically for the Baltimore-DC metro region. You know, there's no shortage of things for us to really talk about. So today's May 7th. The Fed meeting was this afternoon. There was a press conference after. We obviously have ongoing tariff announcements. We have stock market direction that is getting more interesting to observe. We have housing inventory that's actually increasing. We have buyer behaviors that continue to change week over week. And not only just buyer behaviors changing, but in the different price segments, we're seeing behaviors change a little. So in this video, I want to go over all the things that are shaping the DC and Baltimore market and also talk to you about the difference between the two markets. While the cities are very close, the real estate data is performing a little bit differently. And I think it brings forward an interesting discussion about sort of pandemic living and buying decisions, and then how that might actually be unwinding before us, and then what that means for the local housing market. So first, let's get into some of the inventory data. Now, if you followed any of my videos over the years, you know I truly believe in just the core fundamental principle of supply and demand, and that basically driving everything, especially when it comes to real estate, right? You've always hear location, 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 but really it's location and what is the demand and the supply within that area, and how are those dynamics changing over time, and then what does that mean for either housing activity valuations or whatever. So when we look at the DC metro area, so that's Washington, DC, think of the Maryland counties that touch it, sort of sweeps down to Prince George's County, Calvert County, Charles County, and then all of Northern Virginia, right? Like Fairfax County as an example. And so this graph that I'm showing you here is single family home inventory, current levels. We use a 7-day average just because real estate's always being bought and sold. So kind of using an average over a week, we feel is kind of the best way to track that. And what you'll see is the black line is where we are right now. And it's definitely going up, right, at a much little steeper curve. And we always have a pickup in the spring. And you can sort of see that with all the other years, that this time it's going a little bit more parabolic, right? A little steeper. And what I've noticed as far as buyer behavior, we'll get into other charts later, is that, you know, when inventory is rising, I think the first thought many people have is, oh my gosh, is now a good time to buy, right? You have sellers that might start out being stubborn, but then maybe get a little worried. Then you start seeing prices drop because they see their competition. Houses are staying on the market a little longer. But then if you're a consumer and you see those prices dropping, well, you again might be like, I don't know, man, is it a good time to buy? Like there's more houses popping up, but I also see the prices dropping. So it's always an interesting dynamic to watch it unfold and almost even ask yourself, like, why is inventory increasing? Will it continue? Is it increasing because of stress in the local market? And we're going to touch on all that. I think this is going to be very clear in this video. You'll start seeing something that might make sense and might actually just be a short-term rebalancing that then becomes a new standard floor. So that's sort of where we are right now. Clearly more, right? I would say 5,500 inventory right now. And then in 2024, we were a solid 750 to 1,000 units lower. So it's a pretty big deal, pretty big difference. But before you get too concerned, I want to add 2019. So let's go back to sort of normal, quote unquote, normal inventory pre-pandemic. Where were we? And we were over 9,000 units, right? So if we're at 5,500 today and it's like, oh my gosh, it's like so much more compared to the last few years, we need to go back to a little bit of a reality check to where was it in the 2000 teens? And how does today compare to then, right? Do we still have a shortage? Yes, compared to 2019. Do we have a lot of inventory? Yes, compared to 2021. So everything is relative, but it needs to be compared to something. So we would kind of ask ourselves, like, why is inventory so much lower today? And the one thing I really want to tell you about is more of a story of what I experienced mostly from 2020 all the way through really middle of 2022, right? So rates were rising, but they still weren't like super nutty. They were high. People kept sort of at that time feeling like, oh, this is temporary. The rates are going to come crashing right back down, right? Date the rate, whatever. So let's say through mid 22. So you had 2020, 21, 22, those 3 years. We wound up making it very easy for everyone to buy a new house and keep their old house. most all of my buyers, like a massive percentage of move up buyers, like 75, like it was crazy. They wound up keeping their departing residents. So in 2020, let's say you owned a house and you refinanced it either in late 19 when rates were in the mid threes, or again at 3 or under in 2020. And then maybe you moved in 2021. Now, the move of our local market, I'm speaking DC centric right now, the move was to the commuting areas of DC. It was sort of this mindset of like, well, I can work from home now because this is just this new way of living and we're going to do this forever. But I might have to go in the office 1 or 2 days a week. So I've got to be close enough to the action. I got to be able to drive in on an occasional meeting or something. So I'm going to move maybe out into Montgomery County. I'm going to move maybe into Anne Arundel. So that sort of sweeps to the Baltimore MSA, Howard County, Maryland. We had a lot of DC people, Frederick, right? That sort of sweeps sort of DC MSA. But we had a lot of people move out to the burbs. So commuting burbs though, not, like some areas like California, people moved to like Tahoe or they went to Austin, Texas. And all of a sudden a lot of energy went there. And then of course, they wound up seeing the unwinding effect of that, right? So a lot of short-term rentals, all that freedom of life, like I can work wherever I want to work, that's now starting to unwind and things are becoming more normal. So if a lot of people kept their departing residents and a lot of people moved out into the suburban areas, we can believe that a lot of those rental properties, right? So they kept it to rent it. They would get good cash flow because they had a low payment. Because they had such a low interest rate, a high percentage of their mortgage payment was actually principal, like 40% or more, 50% of the payment. So if they had a $3,000 principal and interest payment, let's say, plus taxes and insurance, and they're renting that place for like $4,000, let's even say they're breaking even, they might still be getting $18,000 a year of principal paid by the tenant. So that's like a good investment, right? Plus a property appreciation. So a lot of those people kept those properties. A lot of condos turned rental, a lot of townhouses in the city, DC specifically, think maybe up to 700,000, 900,000. A lot of those people kept those as rentals, moved out and got their big family house. But then here we are now with a lot of stress in markets. So you had stocks obviously crashing, you had DOGE, you had government spending cutbacks, you have, all the headlines are like, oh, we're going to lay off whatever and, downsize these departments. We're going to shut down these commercial buildings that we own at the US government. And I think what's now happening is a lot of those people that had rentals, they are now just getting rid of the tenant, right? And a lot of leases actually roll. It seems to be in the spring. A lot of people buy houses in the spring. A lot of leases roll in the spring. And I think we're starting to see a lot of those properties that normally would have come on the market in 2021, 2, and maybe early 3, I think we're finally starting to see them come back online so that there might actually be this rebalancing where in a normal world, a buyer, someone moving up, that buyer becomes a seller. I would say the first 15 years of my career, 10% of the people kept their departing residents. It was a really small number. And then all of a sudden it was 75%, right? That's like not normal. And now all of a sudden people have had 2, 3, 4 years of being a landlord and they're like, it's not that fun. My property prices haven't really been going up as much as they were. And now we've got all this weird government stuff. Like, what if I get a crappy tenant? What if they squat? What if they don't pay? What if I can't evict them? Right? There's all that like fear that goes with it. What if all of a sudden we have fewer jobs and property prices actually drop? I need to cash out, get my equity now. And to prove this, I actually did a spot audit where I just went to Redfin. You can do this yourself and just like zoom into houses and just pick an address, go to tax records, and you can just put the address in and look to see if the mailing address, it's really the only indicator we can use to see if it's an investment property, but you can just look at that mailing address. And if the mailing address is not the subject property, the property you're looking up, that means that the tax bill is going to that other property and that they are not living in it. Right. So that would be a measure of it being an investment property. And those records don't update fast. So like if you bought a house in March and you're putting your new place or your old place on the market in like April or May, like the system's not updated. It takes some time to get updated. And so we took a random sample, I think it was 40 properties, and it was 40% of the sales had addresses that were not the mailing address, right? Offsite addresses. So that sort of shows me that yes, inventory is rising, but it actually might be skewed to investor sellers. It might just be this influx coming in, also giving people a little hesitation, then starting to see some prices drop. But what if this is actually it? What if what we're experiencing, like this is the rebalancing? And then as you move forward in this process, and maybe you get some tariff relief, stocks continue to improve, you get a little bit of, I don't know, I saw something on Twitter today that there was some package that was supposed to take the DOGE spending cuts of USAID and whatever they were calling fraud, abuse or something, and that they were going to vote on making that permanent, but they didn't. And that now maybe those places might just continue to get funded. So I don't know what happens with all that. I know a lot of my people that thought they were going to lose their job as part of all those headlines that you read. I know they're still getting paid. I know they're still questioning, is that going to continue for a long, long time or not? Some of them have already found other jobs. Some of them are working 2 jobs right now. And I kind of don't blame them. I think the system, the way they're doing, it's pretty stupid. But I guess my question is, what if all of a sudden some of the overhangs that are keeping people a little soft reverse? Are they going to look at this moment and be like, oh man, I probably could have gotten a decent deal, especially in DC specifically, and look back and maybe wish I bought. So anyway, let me show you the condo levels. I think this is important. So, we just talked about how single family homes, and then we compared it to 2019 and we're like, yeah, it's not that big a deal. It's not a big problem. Well, condos is a different story. So if you clearly see here that not only is inventory going parabolic, but you also are exceeding pre-pandemic levels. So I think, again, a combination of a bunch of people that kept their place in 2021 and 2 are now rolling those things out. And then you did have an exodus in a way of people in the city moving out into the burbs. So you have fewer people, but we have work from home unwinding. There are some other things with condos that I think are also getting resolved. It is becoming about the safest time to be a condo buyer right now, I believe. And a lot of it is just how lending views these condominium buildings. Like in the old day, if we approved a condo building, there's a limited review or a full review. And the full review was really, we just look at the budget and we're like, oh, are they reserving enough money? And that's it. Like we didn't really look too much else. You make sure that they're not being sued for something and they're adequately insured, but we didn't look much deeper. And now lenders are actually getting copies of any engineer report or architect report in the last 3 years. They're looking at reserve studies, which is like a home inspection for like a regular house, where they give the economic life of all the stuff in the building. And then they're looking at meeting minutes in some cases to see, or what are people complaining about? Is like, oh, there's this crack in the foundation in the back and some unit owner is complaining about it. That shows up in the meeting minutes. So because these condo associations know lenders are doing this and there's extra requirements to make sure that there are no structural defects, they're starting to get the reserve studies. They're starting to force fixing stuff. They're rebalancing all the condo fees. So it's actually pretty interesting now, where I think there were clouds over, should I buy this condo or not? I think a lot of that has been fixed. Now, some would argue that the lending rules are obnoxious. I think it's really more just some lenders don't know how to do it properly. But as a buyer, as a consumer, I actually really like the way they do it now. I think it's pretty cool. I think if you are buying a condo, you should feel better about doing it today, especially if there's a reserve study that's already done and done in the last couple of years. And then you can look at the financials and you can look at the budget and look at the future outlays and have a better understanding of, do I think my condo fee is going to double next year or the year after or not, right? So definitely much more safe. So condos we have to keep an eye on. The inventory is going up. I do see a lot of prices rebalancing. A lot of the condo deals that I've done have been 2014 through 2017 prices, not everywhere in the city, but in many areas. So I think that's, again, a good time to be a buyer. All right, I'm going to breeze through some of this. This is the Baltimore MSA, just so we can kind of, I've been very long-winded here. The Baltimore MSA is handling inventory levels a little differently. It's still on the rise, but you'll see a much muted level, especially when I add 2019. There it is, Baltimore MSA inventory trends. Look at that, adding 2019. Doesn't even look like inventory's up this year at all, right? It's shocking, right? 5,000 units back then and 2,000 units today. So again, back to that story I was telling you about people moving out and then retaining their other property. The Baltimore MSA definitely benefited from people leaving the city. I live in Anne Arundel County in Annapolis, Maryland, and we saw that. I have so many people now that live in this town that have DC offices that still have to go. Now, a lot of them have to go back in every day, and traffic absolutely stinks for me when I go in, and for them too. But they are staying here. They're stable. They have now their long-term house. And if they owned a place in DC, they're probably going to sell that. So I think that's what we're feeling with inventory levels. I don't think we should get overly shocked. I think if people are interested in buying, you should look very micro, meet a good real estate agent. I always love talking about this stuff, and I can drill down into these other little micro sections, right? It could be different from city to city. It can be different from one side of the city to the other side of the city. So you can't really paint anything with a big broad brush right now. I just wanted to shed some light on why I think inventory is picking up at a very high level in the DC MSA, and why things are much, much, much more stable in the Baltimore MSA. All right, let's breeze through the rest of this. Just a quick market update on interest rates, market stocks. I'm going to show you a couple other things I'm looking at. Real estate data, the Altos reports, which are always linked below. So of course, this is my mortgage tracking software that I like to use. It shows all the bonds and all the economic reports and the stuff that's coming our way. Green is good. You'll always hear me say that. We want to see lots of green on these screens. The thing is, the Fed meeting was today, and we didn't get a lot of reaction. We got what we expected. I think if there was one thing the Fed said today, it was more maybe an argument of tariffs breed uncertainty, but everything else looks like it's moving in the right direction. So really, truly, all eyes likely are on how this government is handling all the tariff negotiations and when that might actually start biting and hurting. So that was clarity in what really the Fed is focused on, and had confidence that they're cool with inflation as long as we get this other unknown behind us. This is the average mortgage rates chart. Now, rates are confusing. I'm going to do a video on that soon, where people can understand how loans are priced. But if you take an average, an aggregate, then, and you're always using the same average based on the same loan structure, you can at least get direction. And what you'll see is this is the trend since April 10th. So a month ago, we have gone from 7 down to like 6 3/4, 6.8. I have been quoting many people in the low 6s, low 6%, even high 5%. Depends on structure, down payment, first-time home buyer or not, income levels, location, whether you pay a point or not, right? All that kind of stuff. So again, real rates can be a lot better. These are just industry averages I want you to see, but trending in the right direction. I drew this sort of line here just to show the trends of kind of what's happening. We seem to be in an area where we're going to converge here, and I'm curious what this new direction is going to be. Are we going to kind of like break out of this high-low range, move even lower throughout the year? I do believe, this probably converges end of July. It's coincidentally sometime right around when all this tariff stuff starts being known. So I'm curious to see how this continues. Now on the financial market side, this is the S&P 500. And you'll see, we've rebounded a ton. And the reason I like talking about the stock market is because it is a measure of wealth of people. And the wealthier you feel, the better you feel about your investments, the more likely you are to spend and do stuff and live freely and vacation and eat out and buy cars and whatever. And as stocks rebound, it tends to give people more confidence. All that said, I don't know if you can see this very well, but we are bracketed, like bounced over the 50-day moving average. These are sort of like technical patterns that traders use to just sort of show direction and expected future behavior. And but yet we're still under the 200-day moving average. Some people believe that we are going to go up here to this 200 pretty soon and then roll over and the market goes to new lows. Others believe that a lot of the tariff rhetoric and a lot of the we're going to shut down all these government offices and fire all these people, that the rhetoric with all that stuff is probably not as tough as what reality is going to be, and that we're just going to blow through this and you blink your eye and we're at all-time highs in the middle of the summer, by July. So some people are kind of in that camp. I don't really know which one I'm in yet. I do feel like biases towards the upside in the stock market right now. Another big thing that we look at is oil prices. So, this is oil. At the beginning of the year, we were up at $80 a barrel, and now we're down at under 60. So 25% improvement in oil. That is sort of a leading indicator of like inflationary metrics. You could either say inflation's improving because of that. You could say, oh boy, is the economy falling apart? Is the global economy weakening? And that's why oil prices are down. You could say, wow, are the Saudis just trying to like really ratchet up production in order to hurt or cause some of the US drillers to pull back and shut down some production? They did that back in 2016. Was the last time I think we got in a quote unquote oil war with them. So just things that we're watching. So oil is moving in our direction that you want to see, cheaper, lower. Stock market is moving in the right direction, up. And then mortgage rates seem to be improving. So those things this week should be net positive for us. Now, the Altos reports, again, if you've watched any of my videos, I believe in inventory being everything. I already shared with you the inventory numbers. One thing I would sort of like to point out, this is the DC metro area, is you can look at the bottom of these reports and you can see new units and absorbed units. And I like looking at that to see really the behavior of what is getting snatched up, like what percentage of those quartiles of houses are going under contract. And you see at the bottom here, the bottom quartile, so houses that are the first 25%, right? 0 to, in this case, 450,000, that they are almost, you bring one out to market, it sells, right? Then you sort of move up the ladder, you get up to that second quartile. It's not hateful, right? So 80% of the houses sell pretty quick. And then you get up to the third quartile and you see it's like half, right? A little more than half. And then of course you get into the big expensive houses and it's half. So what we're seeing is lower end houses are very active. And that makes sense because a lot of those people just buy if they feel confident in their job. If I know I'm going to have my job and I know I'm not worried about it and I have enough money to buy this house, I'm going to do it. If the stock market crashed, my 401k went from 20 grand to 18 grand, right? Or 16. Like it's they lost money, but it's not like shaping their lives. As you get into these bigger price points, you tend to get people that are more economically sensitive in the middle. And, think of people that are somewhat self-made or people that have, they had college debt that maybe they just started paying back, right? Or just paid off. All the money they've saved is theirs and they've watched it go up a lot the last few years. And then once it starts pulling back and they hear of all these other things coming down the road with like government spending and whatever, you might start pulling back. You might wait a little bit. I also believe, again, in that inventory, let's get back to that chart. Now, specifically for this sort of DC metro market, like this third quartile, I would actually put a lot of those houses, see how there's 257 new, it's sort of balanced somewhat equally, right, with the others. But a lot of those, I would put the majority of the rentals I see coming online that aren't condos, and this is a single family home report, I would put in that range. And actually, but my face might be covering that bottom corner, so you can click the link below and kind of dig in if you'd like. But again, you see these inventory numbers really flying high, right? So an average of 5,550, let's say, peak 2022, the world was ending and rates were 8%. No one's ever going to buy a house ever. We were at 6,200. So we're about 10, 12, 13, 14% ish. Montgomery County, same thing. And you just see that big jump, boom, right there. Again, percentage basis, it's big, from 580 to 664, but we're not talking but 80 houses, so no big deal. Same kind of basic breakdown at the bottom. You see the people in the middle are just a little softer than the people at the lower end. Lower end snatched up really fast. Fairfax County, same thing, inventory exploding. A little weaker across the board as far as absorbed goes. Actually shocks me a little bit. Baltimore market, again, muted inventory increase, very seasonal, very normal. Nothing here screams to me like, oh my God, the world's ending. And everything seems mostly balanced. And then you see more buyers than sellers in the bottom two quartiles. So again, I think you're going to keep seeing that. Prince George's County, I haven't looked at in a while. If there is a market that is going to be sensitive to government layoffs, it's going to be the Prince George's County market. It's very, 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 very high, dense concentration of government employees, like the ones that might be in that space where their jobs could be in jeopardy. And here we do see inventory at, let's see, 721 versus the peak of what, 900. So, and last year, well, this is end of last year, 770. So definitely showing some areas of stress, look a little balanced with new and absorbed. Doesn't look disastrous there. Anne Arundel County, it's kind of where I live. A lot of what I told you about sort of lack of inventory. A lot of people moved out here, snatched everything up. That the rental properties they might sell is not here. It's probably somewhere else. And you see more balanced at the bottom, right? More buyers than sellers again, all the way up, first, second, third quartile. So that's actually very promising. And there you have it. That is our weekly update. I know I talked really fast, went through a lot of stuff. If you have any questions, please drop some comments below. I'm curious to get your thoughts on what you think is going on in the world of real estate and more just the economy, because the economy is real estate. The local economy is real estate. The behaviors of people in the local economy, and are they buying things, right, or spending, that is key. So drop some comments, let me know your thoughts, and I hope to see you next week.